Well, I want to welcome you to the marathon that is the Milken, and you are at the very last session, or second to last, I think. So thank you so much for being here. Today's session is really about two things. One is an opportunity for the winner of the Kellogg Morgan Stanley Sustainable Investing Challenge to present their idea, but really what you're getting is a snapshot of something that we observed about 10 years ago. And my name's Dave Chen, and I head up an investment firm that Equilibrium that focuses in on sustainable themes executed in real assets for institutional investors. But I also do something that's been perhaps one of the most gratifying things that I've ever done, and that is for the last 10 years I've taught at Kellogg, and I started the program there in impact investing in sustainable finance. And the story is this. Because I'm working and I'm running an investment firm, I don't have time to grade papers. So I made the class project worth 100% of the grade. And this was 10 years ago. And the job was for these students to invent an investment strategy that executed some sustainable challenge and ask them to innovate with finance how to solve the problems of society, the environment, and as you all well know, and this conference is a great example of it, there's no end to the big capital market opportunities in quote-unquote sustainability. What happened that first year was I was really shocked by the quality of the work, and by the way, many of you in the financial services know just exactly how hard it is to do product development in our sector. And so these students had done such a great job. I asked the question to myself, I wonder how many other grad schools where students, and this is 10 years ago, are wanting to be on the leading edge of this issue and are thinking about these same kinds of ideas, and could we create a competition around that? And not focused on social entrepreneurship, the solar power flashlight, but around finance as the innovation capacity. So that's how the Kellogg Morgan Stanley competition came about. So could I get the first slide? So what I wanted to do before I introduced the team was sort of give you an overview. So we're now in our 9th year of the Sustainable Investing Challenge, and this year we had well over 80 schools participate. And so by definition, this punches below the top 20 grad school programs in the world. Probably the proudest moment, I think, for me personally in the last 9 years is that one of the competitors that made it to the final 10 or 12 was an agricultural university grad school team from Indonesia. And they had come up with a brilliant investment strategy, and it also highlighted the fact that our competition is conducted in English, and so it made us very sensitive to the fact that if you're not articulate in English, we should not disadvantage you. So truly, we've learned a lot in this competition. So this year, the stats are this: 80 schools participated, and 109 teams submitted applications. From that, we culled it down to the top 12. Could I get the next slide? This, don't want you to read this, but this was the kind of plans that they came up with in the final 12 that made it to the 2019 competition. And you can see from just glancing at it, the number of schools around the world that participated. The second school is pretty interesting. No, actually, it wasn't the second school. It was the Greater Green. This is a group of 4 Chinese students that were undergraduate classmates, and then they all went to different grad schools, so they came back together with a 4-school submission. So next slide. These are the final 4 teams, and today we're going to allow the winner of the competition to give you an idea of their innovation and their fund idea. Next slide. So this thing has progressed over time, 2013, 2016, 2019, and you can see the growth in the number of schools. But I think what is perhaps even more interesting than just the raw number and the growth of schools is just the level of sophistication that we're seeing out of these students. In 2015, they came up with what is effectively an environmental bond and it was probably one of the coolest moments. We actually did it in this room, and I happened to be sitting at the end of the room at that day, and one of the participants in the room had to leave midway. Came up to me quietly, gave me his business card, and said, "Would you give this to the kids?" And it was Chris Ailman from the CIO of CalSTRS, and on it he had scribbled, "We think we'll take their equity round, and if they have a debt round, we might do with that too." So, by the way, the punchline of the story is that the one of the kids on the team's father is a very well-known investment manager, and he called me up that night and said, I've been wanting to meet with Chris Ailman for 6 years now. And so my son beat me to it. Next slide, please. So I think this is the other thing that I want to give you an exposure to, and that is, look, in social enterprise and in entrepreneurship, it's relatively easy for 3 grads or non-graduates and a dog in a garage to come up with a product and launch it. And for those of you in the financial services industry, you just know how tough it is to actually create a financial services product, and let alone do it as 3 new grads. One of the things that's important in that slide is the number of students that exited this competition, exited their graduate school program, and actually tried to make their instrument real. On that list, there are a number of those teams that have actually taken it to market. Blue Forest up there launched their first $4 million environmental climate bond this year, and it was picked up by 4 institutional investors. So it was effectively their pilot green bond. So a number of folks here have actually executed to this. So without further ado, and we're going to leave plenty of time for Q&A here, I'd like to introduce Tom Field, David Mallett, Claire Pluard, and Sam Max Schiller from the winner of this team, and I'll let them take it from here.
Fabulous. We're excited to be here, and thanks so much for coming to our talk. Thought I would give a little bit of background about how we came to this idea in the first place, and give ourselves a chance to introduce ourselves as a team, and then we'd love to give you our pitch and get your feedback and ideas. And we've found that Milken is this incredible community of folks that have represent quite a bit of assets and represent quite a bit of ideas, and we're excited to bring you into one of ours and collaborate. I have, for the last 10 years, been involved in environmental projects. I helped start a carbon offset project development company in Chicago. We developed 21 offset projects that participated in California's cap-and-trade program around destroying refrigerants, CFC refrigerants that are very potent greenhouse gases. And so we scaled that from just 2 of us to over 20 of us, and did some great work. But I got excited about thinking beyond what you can do to solve an old problem around old refrigerants, and thinking more about how our economy is more fundamentally run, and where there are really strong opportunities to make a climate impact. And so I spent some time after I exited the company in March looking at climate solutions, looking at Paul Hawkins' book, who was sitting on the other side of this panel yesterday, talking about some of these issues, and got really interested in agriculture as a potential a catalyst for climate impact, and also for improving farmer prosperity in the process. So through Kellogg, I've had the opportunity to incubate this idea as an enterprise, and to take it to a class, to Dave Chen's class, and think about how it moves beyond an enterprise, but really to a fund level. And that was the opportunity that brought the rest of this team together to examine how we could catalyze these kinds of transitions to regenerative agriculture, to sequester carbon, and to also bring farmers into organic markets and give them a premium beyond what they're doing in regular commodity markets. So that's a little bit about my background and how I encountered our team, and I want to pass it to Claire to tell a little bit about herself.
My name is Claire Pluard. I'm a Chicago-based social impact. I've worked in nonprofits my whole career, and so I have a lot of experience doing fundraising, especially for project development like new projects, and government relations, and now I'm in impact measurement, so kind of seeking cross-social sector solutions to actually be measuring, improving our effectiveness. And I'm an MBA student with a focus on social impact and looking for kind of broader systems way to leverage financial tools and make a better world.
I'm David Mallett. Prior to my time at Kellogg, I spent 4 years in investment management, particularly at Morningstar. So I have experience in the 401k, defined contribution space, and solutions there. I guess as it relates to sustainability and thinking about some of the things we talked about here, and Milken was at Morningstar when they acquired Sustainalytics and kind of the rise of ESG and thinking how that impacts retail investing.
And I'm Tom Fields. My background is in finance and entrepreneurship. So in addition to my involvement with Carbon Yield, I currently work at Kellogg Capital, which is a private credit asset manager focused on originating leverage loans to middle market companies. Prior to that, I started a water sports business down in the U.S. Virgin Islands. And I got really involved in this project as I saw it as a unique opportunity to apply some of the more traditional financial models that I've experienced in my career to a unique space and an area that's kind of underserved in the capital markets today.
And I would just emphasize that the kind of backgrounds that these students are bringing into grad school, and then what they're looking for is how to use the implements of both their experience as well as finance to actually do something different with those set of tools and to change the world. And it's not just the Kellogg team that won the competition this year. We're finding that across all the grad schools and across schools that aren't just in the top 20 globally. So it really is a cause for inspiration. So with that, I'm going to turn it over to you guys again. Let's pitch the deal.
Fabulous. So again, I'm Sam Schiller. I'm a founder of the Carbon Yield Fund. Our fund addresses two pressing challenges: climate change and commodity markets that no longer sustain grain farming, particularly in the Midwest United States. Soil is our most critical natural resource. Our fund attempts to regenerate soil in ways that align farmer prosperity with environmental progress. This slide represents what regenerated soil looks like. We've talked a lot about regenerative agriculture at this conference, but this is what it looks like on a farm level. Notice the covered ground, multiple crops, and deep root systems. These lands can sustain heavy floods and drought, and because their plants synthesize carbon from the atmosphere and exchange it for nutrients in the ground, these healthy soils don't require external inputs to thrive. And because the soils and land doesn't require external inputs, and because this land can also be used in premium markets, which we'll talk about later, regenerative agriculture is not just good for the environment, it's good for business. The next slide shows you what conventional agriculture looks like. This might be a fairly familiar image of bare fields in tilled up soil. After every harvest, farmers in conventional farms till up the land, basically dredge up all of the carbon-rich life that's in the soil, and essentially oxidize it and emit it to the atmosphere. We've been doing that for a long time, and over 30% of our greenhouse gas emissions since the Industrial Revolution are attributed to agriculture. And we can only keep farming this way for so much longer. We heard Carla Vernon from General Mills talk about how we only have 60 harvests left before we fully degraded our topsoil. Our fund finances transitions to regenerative organic agriculture. These are practices that rebuild the soil, they draw down carbon back into the land, and they lead farmers to more viable markets. We help bolster that transition by registering carbon credits, which help compensate farmers for the environmental benefits that they're creating. And those environmental benefits are substantial. Per acre, regenerative practices can sequester 2.5 to 6 tons of carbon per year. And if you were to aggregate that, if you were to adopt these practices internationally on agricultural lands, you could offset 1/4 to half of our annual global emissions.
So Midwestern farms has the highest rate of soil carbon loss in the world. This about 70 tons of carbon has been lost per acre in the Midwest. And this is also the dominant region of commodity grain, corn, and soybean, particularly production in the United States. And with this in mind, we think it's a perfect place to focus our fund. Next slide, please. These commodity grain markets are no longer working for the farmers. They're facing really decreased prices, especially in the last few years, and the cost of inputs have been sharply rising. They also are required to apply more and more of these inputs, like pesticides and fertilizers, to sustain their yields, which further shrinks their margins. So in the Midwest since 2014, the farmers are losing between $12 and $57 per acre a year. So, we propose a solution that addresses both of these problems. While not all organic farms are regenerative, and vice versa, if you pair those two, you have a practice that both restores soil and moves farmers towards profitability. During a 3-year transition period where farmers go chemical-free, after that time, they see a 50 to 200% price premium on their organic grains, which comes to $200 to $300 of profit per acre per year. And using regenerative practices like no-till, cover cropping, varied crop rotations helps facilitate the organic transition process and makes it easier for these farmers. Next slide, please. The obvious question is, why aren't we doing this already? And the answer is there's a huge upfront cost. An average 2,500 acre farm will spend about $1 million during the 3-year transition period. And during that time, they also face unfamiliar practices and decreased yields, and so they need other supports that would help them overcome those barriers, and that's what Carbon Yield proposes to do.
So our fund would help farmers address the financial barriers to organic regenerative conversions by providing operating loans of up to $400 an acre, or for our target farms of 2,500 acres, that translates into approximately $1 million per farm. We would offer those funds at a 7% interest rate, and to help farmers with the liquidity through that transition period, we would allow that interest to be paid in kind, to be added to the balance of the loan instead of being paid out in cash during the transition. It would then amortize thereafter. To address the operational barriers to adopting organic practices, we would provide them with internal and external resources to help them develop the organic operating plans that help them identify the correct crop rotations and things to help them be most effective. And as Troy mentioned, thereafter, after the 3-year conversion period, the farmers are able to access a 50 to 200% price premium, thereby increasing their financial viability to repay the operating loans to Carbon Yield, and also increasing their profitability thereafter. In addition to that, we would take on the role of certifying, aggregating, and selling the carbon offsets generated through the regenerative practices. It reduces the risk for the farmers. And in exchange, Carbon Yield would we had proposed that Carbon Yield would receive 50% of the carbon credit revenue generated for 10 years from the farming practice. And so the graph here kind of illustrates how this would all work and how things would fit together. So the blue bars reflect the cash flows to farmers associated with an organic transition. As you kind of see in years 1 through 3, those farmers are losing between $275,000 and $350,000 a year for our target 2,500 acre farm. And so we would off that with Carbon Yield loan funding, and then also the carbon credit revenue share that goes to the farmers. As a result, the black line there kind of shows the net impact of this, and farmers are financially viable throughout the transition period with substantially increased profitability thereafter relative to their current financial conditions today. We think this is a strong alignment of interest with the farmers. It addresses kind of 3 key risks they face: the operational risk of developing and operating these regenerative organic practices. It addresses the financial risk of funding the conversions and providing them with access to capital that markets are currently not providing them today. This capital is that capital that farmers just don't have on their balance sheets either. And so it needs to come from somewhere, and we think that we'd be a good solution for that. We would also help farmers address the carbon banking risk, as we would be able to pool the carbon offsets and then find buyers who are able to take those on at scale.
So we
had structured our fund as a rural business investment corporation. It's analogous to a small business investment corporation for those who are familiar. The reason for this structure is that it provides us with access to low-cost leverage at a 50 to 60 bip spread relative to U.S. Treasuries. And so we had targeted an original fund of approximately $40 million of assets. That's about $13 to $15 million of equity, and 2-to-1 leverage via the RBIC debentures. And through that, we would be able to support the conversions of approximately 40 farms at our target 2,500 acre farm size. And through this offering, we're targeting a net IRR to our investors of 10 to 12% net of fees, which include a 2% management fee, and then a 20% incentive fee after a 6% hurdle rate would be met.
We see a very large target market for this initial fund. In the Midwest, we looked at how many farms met our acreage requirements and the operational requirements for the fund. There are over 11,000 farms that are sufficient size, representing about 33 million acres. We're talking about the first 100,000 acres within an initial fund, which represents about 40 farms. We see, again, significant growth potential in the Midwest and in other markets. But in order to actually find farmers to do this, we have to rely on some channel partners. I've done some consulting with organic infrastructure grain providers, such as Pipeline Foods, who are helping to bring organic grains to market. And they're providing transitional pricing for grains as they move through to help farmers get a little bit of a premium as they are transitioning to organic. They also provide a significant amount of agronomy support to help do farm management plans. They would be a key resource to help farmers successfully make the transition and know that there's actually a market for their grains once they get through. We've also been in conversations with NRCS and hope to connect with private crop advisors that can also provide some grant resources as well as on the ground, literally, support for farmers making this transition. And we also see CPGs as an interesting partner. We've heard a lot from General Mills at this conference about their commitments around sourcing regenerative grains and hope to identify folks within their supply chain that can provide those grains. We do have some traction. We've started doing this work at a pilot farm. There's a 2,500 acre farm that has already undergone this transition to regenerative organic practices. And we hope to register carbon credits on their behalf with the verified carbon standard. We expect to get 3.4 tons per acre per year from that. And we're also working with a biological lab that is helping to provide extra resources and credibility to this project. And we hope to, through that experience, create a streamlined process and a software product that would allow us to scale this and limit the pain that farmers go through when they actually register their credits. We have also made sure that there's a buyer for carbon on the other side of this. While there are not compliance markets that accept yet soil carbon projects, there are a variety of voluntary buyers of carbon offsets that have expressed interest in these type of credits, and we've reached out to them. We've talked also to carbon brokers who have vested bids from corporations that are interested in complying essentially themselves with the Paris Climate Accord and want to do that in part through procuring offsets. So we hope to work with them to create bulk offset deals. We also see major growth within the aviation industry that has made an international commitment to carbon neutral growth in the future. So we see Corsia, their aviation emissions reduction program, as being a big source of growth in the value of these credits over time. But so far we're projecting just $7 within our model per ton, which is a pretty conservative price with a lot of upside in the market.
So we're going to need some investors, and we plan to target family offices, large family offices specifically, as a real estate investment that has sustainable impact. When we look at the family office landscape, the average family office, their third largest allocation is real estate right now. And we feel our fund and our farms, particularly in the Midwest, provide a nice complement to the commercial and residential real estate properties they currently hold in their portfolios. Based on our research, we've found there's a transition right now occurring to the younger generations within family offices, this transfer. And with that, you see a rise in the need and want and desire for impact within these family offices. Right now, a third of family offices are invested in some sort of impact, and as a whole, family offices, 50% are looking to either get involved in impact and invested in impact, or just increase their allocation. And we think we provide a nice investment vehicle for that increasing demand. We looked at risk from a couple different perspectives. One of the large risks being that lack of farmer adoption. As we said, this is not an easy transition, and we're really going to need to partner with those boots on the ground, NRCS and some of those other partners that are there that Sam mentioned, in establishing trust with the farmers. That's really the only way this whole thing works. When we look at risk in the marketplace, we looked at the organic price premiums, and we don't feel like that's as strong of a risk for us right now, just based on historical price premiums and the sustained demand for organic out in the market. And then on the carbon market side, we see risk and mitigating that risk with finding knowledgeable brokers that can help us navigate the marketplace, find large buyers and lock in contracts, and help us mitigate price risk of those carbon credits. Here's our execution roadmap. As Sam mentioned, one of our, we feel like, competitive advantages with getting this fund moving is that we have this pilot project already there to identify, what are we able to sell these carbon credits for, and how could they make our fund work. And then we have a vision beyond even just one fund. If this is successful, we'd like to begin funding even a second fund and think even about international markets and what that could mean for our fund, and tapping beyond family offices, institutional capital, and pension funds.
So with just the first 40 farms, we'd be able to draw down 340,000 tons of carbon from the atmosphere, which would result in 100,000 acres of improved soil quality. The crops on these farms, they'll be much more resistant to extreme storms and droughts and the other effects of climate change. And there's also huge benefits to organic farming without the chemicals entering the water pollution. The carbon yield farmers will be more economically viable and prosperous in the long run. So thank you for listening to us. We are Carbon Yield, and we'd love to continue the conversation.
Thank you. So, just to recap, and if we put up slide 3, almost all the top teams that competed did exactly this, which was take a problem, decompose the problem into the causes, but also the economic benefit, and then create a financial solution, a fund or a strategy that allowed investors to tap into that benefit once it was accrued. What you saw here was, in 10-15 minutes, an incredibly concise piece of work, and that in of itself is pretty amazing from these student teams. With that, what I'd like to do is just invite your questions to the team and about anything else that might pique your interest. Yes.
Microphone.
Mike?
You guys talked a little bit about the premium of organic crops versus, standardized crops. Can you talk a little bit about the cost for somebody operating an organic farm versus a standard farm, and what that cost benefit looks like?
Sure. So studies have shown over the past 40 years that organic price premiums, both domestically and internationally, range anywhere from 50 to 200%, depending on the crop that you're growing. So our crops, which we focused on organic grains, that's mostly corn and soybeans, saw anywhere from a 70 to 150% price premium. While there is a slight increase in the cost to operate an organic farm relative to a conventional farm, it's not as large as you would think, because instead of having the costs associated with pesticides and nutrients, those costs are you don't have those in an organic farm, but you do see those offset by increased labor costs.
So if you were to guess what that cost is that a 10, 20%?
It's between 10 and 15%, kind of based on your geography.
One question, actually one comment. It makes sense to do this as a real estate bucket, but recognize that the macroeconomic conditions that affect traditional real estate will be different than affect this. Mm-hmm. So this actually is a nice diversifier, so make sure you also show it as a diversification tool as well, so families can choose which bucket. The other question relates to the chart of cash flows. Is this going to pay out any quarterly distributions when income is received, or how exactly does the payment stream likely look like?
Sure. So when we originally had developed our fund, our idea was to use some of the revenue generated through the operations to help fund some of our additional farm investments in years 3 through 5. Thereafter, once we kind of tapped out on the loans that we'd be making to our farmers, just we targeted farms in years 1 through 3. It's a 3-year conversion process, so we're originating loans for 5 years. Thereafter, you would be able to receive distributions. With the SBIC program, equity investors can receive distributions subject to certain leverage limits.
Can you talk a little bit more both about how you decided to come up with this idea, if there were other things that you rejected, and also kind of your engagement and commitment to trying to make this go forward?
Yeah, I'll take that. We looked at a couple different models of how you could think about regenerative agriculture investments. So I also examined other sustainability opportunities, but I'll talk a little bit about some of the other options we examined. We thought that you could potentially buy land as a way of kind of changing the incentives around implementing regenerative agriculture and thereby improve the productivity of the land and reduce the input costs. That this seems like a really great opportunity. If you were reliant just on farmer adoption, it might happen a little bit slower. But what we found is that land is really overpriced right now. That development pressure on agricultural properties and some of the kind of financial engineering that farmers have to do to stay afloat have inflated the values of farms. So we found some funds that are actually doing a land acquisition strategy and are having trouble exiting because the land value does not reflect the improved productivity and soil health, essentially. So that was the other big issue we were wrestling with. But I certainly was interested in looking at other models. I have a history in renewable energy project development and looked also at storage technologies and hydrogen, and felt like a lot that was happening in energy was already on a really positive trajectory, that solar and wind, I think by 2020 in most places, will be cheaper than fossil fuel energy, which is exciting. And it is now an execution problem of just getting that throughput out there and figuring out how to deal with some of the incumbent utilities. But I did not feel like that was a problem that needed my effort. But it felt like farms were not thought of within the climate change conversation. And because I'd had this experience working with farmers as part of my wind project development days, felt like I had an ability to really contract with farmers and earn their trust, and felt like this was, if agriculture represents about 30% of our emissions, that could be a really substantial contribution to mitigating climate change that was not yet on a strong trajectory. I've certainly been encouraged at this conference and elsewhere, seeing that more people are committed to food as a solution to climate change. But we want to contribute to that conversation and think this is really valuable. As far as my personal commitment, I am full-time working on this while I'm part-time in business school. We're trying to figure out exactly how this gets rolled out, because there still is some risk within our pilot project and want to iron those details out. But the team is committed to pushing this through, and whether that is while they do their full-time jobs and this full-time job, or in a dedicated way. I think it depends on how we roll it out, but we're really committed to seeing it through if possible.
Anybody else? What are the couple patterns that we see across a lot of the teams? One is it could be a hot issue, and they're just personally curious about the idea of how do we apply capital markets to these problems. But oftentimes what you find is that they carry something from either a personal experience or something from their prior experience, and now it's time to answer the question, can I apply capital markets to it? A lot of the I was going to say the deals, but the funds that came out
Soon to be
of
deals.
that came out of the prior years all sort of share that pattern. There's also a funny attribute which is sort of inexplicable, and that is plans come in waves. So a few years ago, ag was big, and then all of a sudden it was social impact bonds were big, and I'm making a prediction that in 2020 we're probably going to see oh, by the way, this year a lot of recycling, circular economy deals were big. I think in 2020 we'll probably opportunity zones was a huge thing. Okay, and so there is a little bit of faddism and inexplicable to it, but that's kind of makes it kind of interesting. Next year, I'm sure we'll see a lot of plastic deals. So next question.
Yeah, congratulations on some nice work. So when you look at what is the average revenue of one of these, target farms? Can you just give me a sense of that?
Well, it kind of depends on what crop they're growing. So we, through our model, these farms on the revenue side with the 2,500 acre farm, I believe we're seeing 1.5 to 1.7 million dollars for that 2,500 acre farm.
So that's what you've modeled in their
Yes.
average revenue per farm.
Post conversion, correct.
So, and you're securing the loans by a first mortgage.
So we recognize that some farms have indebtedness. Some people might see that or argue that farmers are more indebted than they were in the past. There is a little bit of nuance to that. So we're targeting large farms over 1,000 acres. And when we actually looked at the data behind that, these farms aren't nearly as indebted as they were in prior years. They're actually at a relatively low level of leverage compared to the past. And so our model was that recognizing that some farms carry some level of indebtedness, we probably wouldn't be able to have a first lien senior secured loan, but we would be secured, backed by the property of the business, probably as a second lien or something.
And what type of, in your model, what type of default risk have you contemplated?
So using this to comparable second lien farms of this size, we use a default rate of approximately 2 to 3%. We did look at the sensitivity of our returns relative to that default rate, if that goes up from 2 to 5%.
Yeah, if you go to slide 30, we have some of that model too.
The interesting part is that our real ability to create value comes from the carbon credit revenue share. So for these farms, with a $1 million loan at 7% interest rate, you're seeing about $70,000 of interest coming in. Our share of the carbon credit revenue of 50% is approximately $60,000 a year. And at the same time, those farmers are able to, I'm sorry, not 60%. The total carbon credit revenue generated by the farm would be $60,000 a year. Carbon Yield would receive half of that, and then the farmers receive the other $30,000 of that, which they're able to use to offset their interest rate. And so our sensitivity to our IRR is more dependent on our ability to capture value through the carbon credit revenue.
Yeah, good. Because a scenario where you have large defaults and foreclosures would be catastrophic, politically and otherwise, in the marketplace. But there's a nice hedge in there the way it's being designed on that. But one other just note, and unless you have a further comment.
Well, just to that point, and we'll make sure you can follow up. The other interesting thing about regenerative practices that we don't accentuate as much in this is that there is a resistance to extreme weather, and that regenerative farms typically fare much better. Even if, let's say, your crop is wiped out, they're better able to implement a new crop right away, so it's not a total loss.
Yeah, because catastrophic risk is a big issue
Yeah.
you're dealing with in some of this.
Certainly.
And then one last thought, and thank you. You've got water is another important asset here, and farms consume massive amounts of water. So I think there's a sequel to what you're doing here around a water strategy as well. So congratulations and good luck.
Appreciate it.
Thank
you so much. And we're thinking about some of those water issues, and it's a little hard to monetize right now, but there may be, in certain areas, utilities that can provide some incentives around water. So we're aware of it, but it's not quite as actionable yet.
Hi. Could you just talk a little bit about the market for credits that you tap into, how the pricing is determined? Also, if you see any likelihood of that pricing expanding over time, or other type of credit or offset markets you might be able to tap into, or even help with the genesis of, but some way to increase that stream, both for your benefit and for farmers for whom the current pricing might not be sufficient for the sort of things you want them to do.
Certainly. So what's been interesting in some of the compliance carbon markets is that rather than California taking in project types right away and being the first one to test them out, they have often relied on voluntary markets like the Verified Carbon Standard or American Carbon Registry to really show that the credits that are generated are robust and strong and can be verified. So I could imagine soil carbon projects migrating into some of the compliance programs that already exist or are going to come into existence. California has been an incredible leader in this area, and in fact, they have made a subnational push for other entities to come into their program. So they've partnered with Quebec. They've been in conversations with Mexican provinces, with Chinese cities. They have really seen that if you cannot rely on the federal government necessarily to implement carbon pricing, there may be other ways to accrete more emitters that would buy these kinds of credits. So I can imagine some really interesting opportunities as entities are are committing to the climate accord, even below the federal level, that we could participate in some of those programs. Most of the work we've done in our modeling has been in this voluntary environment where there are corporations that are sensitive to their to the PR impact of being exposed to carbon. The tech industry is very interested in these. I think Lyft made a very strong commitment to offsetting their emissions as a differentiator in their business model. So we see some demand there, and that's certainly growing. There's also a lot of interest in insetting, that looking at your own supply chain, so like General Mills or others, to figure out how to not reach into a different sector, but to within your own supply chain reduce your greenhouse gas emissions. So there may be opportunities, particularly in the food sector, to connect with corporations that are interested in that. And then I talked a little bit about the aviation program, which once it's implemented in 2020 would represent a bigger market than California's cap and trade market. And that is a very attractive market. There's still a little bit of uncertainty about how it gets implemented and when it gets implemented, and what project types they'll take in, but we're pretty confident that they'll be interested in these types of projects and represent a really strong market.
Congratulations, by the way. Have you guys given much thought? Do you want it to be balanced between soybeans and corn? Most of the farmers, particularly through the Midwest, do both. So do you have and it's been a rough period for soybean farmers particularly.
Yes.
So do you care about that? I mean, have you thought about what that balance needs to look like, or is it better for one, not as good for the other?
Well, part of the regenerative practices, it centers on the crop rotation. So there'd be naturally a more balance because on a 5-year rotation, they're going to be doing corn, soybeans, wheat, and alfalfa. So essential to the practices, there will be a rotation and variety. And then it depends for our fund year by year if we can stagger each farm onto a different rotation. So we have that sort of sustainability.
Price dictates some of that, right?
Right.
Farmers are trying to rotate just because it's the right thing to do.
Mhm.
The price does, dictate, I'm going to plant a little more soybeans because I can make more money.
And what's interesting is there's a lot of different parties trying to address this issue. One group that's really working around that is called Mercaris. And so they're actually providing live pricing for organic crops, and they're also creating a futures market within that. And so tools like that, like third-party resources like that, will be able to help our farmers evaluate the proper crop rotation and figure out what crops they're able to plant, both economically and then also to maintain their soil health.
Since farmers are getting more sophisticated, certainly over the last 30 years,
Yeah.
Will you allow them to hedge and kind of sell that grain ahead, or have you guys thought about what happens at that level too?
Yeah, so
Some of the risk away, obviously, you have to deliver, but
yeah, so we're within our model. If we looked at the farmers' exposure to the price volatility of organic crops and that premium, if that premium were to decline by over 50%, what we found is that our farmers are more financially viable with this, even after serving the debt than they are today in conventional farming. And we're not looking to capture the revenue generated from the organic price premium. What we're looking at is more collateral protection to us. And so we would be very supportive of them being able to hedge and enter into futures contracts that provide them guaranteed prices and kind of mitigate the risk on their end.
Yeah, and it's interesting that we, in talking to Pipeline Foods, who I've done some work with, they said that they offer to farmers that have made the transition a longer-term contract, and oftentimes farmers also recognize that the organic market is really attractive. We found that the market is growing about 15% per year, but the rate of adoption of organic farming is only increasing at about 6% per year. So they're seeing that spread too, and often the farmers say, I want to let this ride. I mean, they're very interested in the free market and taking advantage of those opportunities, and they're taking the risk to transition to organic. They want to see the full return on it. So there's some balance of wanting to make sure that they can pursue their own strategy while also protecting the investment that we're making. So it's an interesting question, but we're hopeful that crop insurance markets also will help mitigate some of that volatility as well as potentially these futures contracts, which are developing.
Given the quality of arable land has been depleting, generally as part of a circular economy context, in your experience, do the farmers use like compost derived from organic food waste? I mean, food waste, for example, is that heavily used in the farming practices?
I think it depends where you are. I've certainly seen in local food contexts close to cities where there is compost collection that farms take advantage of that resource. I've done some work with a firm called Urban Canopy in Chicago that has a produce delivery business, and they also pick up the compost, and then they bring back that compost to their farms and generate the food that then gets delivered. And it's very much in that kind of circular economy mode, which I think is really exciting. I think one of the interesting pieces of regenerative agriculture that's increasing now is integrating livestock, which we don't generally associate sometimes with sustainability, but livestock actually really does improve the soil health. It helps fertilize. It is a natural, I guess it's not technically compost, but it is a way of fertilizing the land in a circular way and generating more of these sophisticated root systems. So that's very exciting. And I think also crop stubbles is another way, sort of mulching and keeping the ground covered and adding those nutrients is a big part of implementing regenerative agriculture. So I think that's seen as a real asset going forward.
Is there any risk that the 3-year crop conversion period gets extended longer? Is that pretty bankable, that period?
Yeah, so the way to be certified as organic, you have to provide proof and documentation that you've undergone 3 years without the use of pesticides. And so it's pretty stable. I mean, there's not ways that would really get expanded out past 3 years, provided that the farmer understands that the documentation required to do that. And so we would help them provide the resources they need to do that.
And I can imagine that if a farmer today were abandoning their transition, they said 1 year in, hey, this isn't working, a lot of that probably has to do with not having enough cash and saying, you know what, I just need to do this, but we're hoping to solve some of that pain with our loan fund and with some of the agronomy support so that they can see the transition all the way through.
Can you also go through the federal program that you're employing to bolster the size of your fund? You're raising $13 million in equity, right?
Mm-hmm.
Plus 2 times leverage on that. How does that program work again?
So the RBIC model it's administered by the USDA, but it's based on the SBIC model through the Small Business Association. You're able to increase the equity tranche of that up to, I think it's $105 million today. So through 2 to 1 leverage, you could increase that program to say $300 million of total assets. We've looked at some alternative structures as well that would involve more of a CLO securitization if we wanted to roll this out on a larger scale to more institutional clients. So we think there's definitely opportunity to scale, but we recognize that for our pilot fund, it's going to take time to identify the correct farmers to undergo these transitions, and so we felt that a smaller fund was better fit for developing our expertise with that.
Well, if there are no other questions, maybe I can just draw this to a close, and that is that between the partnership of Kellogg and Morgan Stanley, we've been conducting this competition now, as I said, in its 9th year. It's inspiring to get involved and see the kind of innovation that our grad students are capable of doing, and meaningful kinds of work. I think the ask I would have of you, and just a show of hands, how many of you went to a business school or a law school, a graduate program? Well, if you're active alumni, I'd welcome you to get your school involved. It's very likely that of the 80 schools that have participated this year, that one of your schools is very likely in it. This is a program that this year I think we ended up with something like 200 investment professionals that volunteered as coaches, judges, mentors, etc. And then we pulled together a group of 18, and the competition rotates between 3-year cycles, 1 year in New York, 1 year in London, 1 year in Hong Kong. We just did Hong Kong. So next year it's back to New York, and the year after London. Every year we have about 18 judges. Typically they're senior, if not managing partners of some of the name brand mainstream investors, as well as NGOs and impact funds that come in, and CIOs that come in and act as judges. So if you have an interest, either at your school's level, alumni level, or as a participant in this, I just welcome you to do this. If you have an interest in the other teams that participated this year, if you go on to sustainableinvestingchallenge.org or .com, it's one of those two. You'll find synopsises of each of the 12, and a little bit about the team rosters, and I think we might even have some resumes up there. So with that, I'm going to conclude this, and thank you very much. And if you want to participate, please let me know. Thank you.